Okay, so we'll go ahead and get started, even though the door's still open. So thanks for coming. This is the Fed Bear Trap Roundtable. I'm not the MC. We're going to kind of all wing it, where we all share it together here. So, but I'll introduce myself. I'm Jeff Clark at thegoldadvisor.com, and we do have these are 5-gram silver stamps. I think they're 3 9s. They have the Silver Symposium on them, if you haven't seen them, and made by the Sunshine Men over here in Coeur d'Alene. So Fed Bear Trap Roundtable, it's all about, the Fed and them being trapped. So I'll just start off and then we'll pass the mic and kind of go from there. So, my view is that the Fed Bear Trap is this idea that they are trapped and they can't, no matter what they do, they're not in a good position, right? If they continue to raise rates thinking they're going to fight inflation, that could cause a recession, it could cause a stock market crash, it could cause lots of things, a drop in tax receipts, and that reduces government revenue, right? And if they don't raise rates, then inflation could continue to rise and perhaps get out of control. My personal view is that inflation is not right now a demand side issue. It's more of a supply side issue. Until the supply side and the supply chain is taken care of, inflation is probably going to remain high. Eventually, if you reduce demand enough, the supply chain can catch up and that could work. But I don't think that's going to work in the near term. That's my view. But that's kind of the overview of what the Fed Bear Trap is. And we'll go from there. And then we'll have some giveaways, and we'll have Q&A if we have time for that, so we can all weigh in. So guys, just introduce yourself and tell us what you think about the Fed Bear Trap.
My name is Mark Yaxley. I work with SWP in the Cayman Islands. What do I think about the Fed Bear Trap? I think we find ourselves in a very difficult situation. Not very fortunate for us, who are seeing our dollars devalued at a rate that hasn't occurred since the 1970s. Not only is it not good for us as individuals, we're not only talking about the unfortunate poor and struggling middle class, wealthy people in this country, in my country, in Canada, in the United Kingdom, and in Europe, are all suffering right now with deflation or a devaluation of their dollars of 10%. In the UK, I read this morning, they predict inflation is going to hit as high as 22% by January. So it's affecting all of us. It also affects our businesses. If you're a business owner, you have cost of labor, cost of materials. Most of that will get passed on to the consumer, so you can kind of hedge against that. But your cost of capital, if you want to expand your business, that capital is going to cost you a lot more money going forward. It might be difficult to build that new building. For example, we're thinking of building a new building right now in the Cayman Islands for a new vault, and cost of materials is up 30, 40%. Every time we get a refreshed quote, it's more and more expensive, and we're actually thinking, can we kick the can down the road a little bit longer? So really difficult situation. One of the things that I want to talk about, and we'll come back to this, is what does it all mean for precious metals? Because I think a lot of us are gold and silver guys. So I've got some information about what to expect there. But I'll pass the mic on.
Oh, there's one. Yeah. Oh, sorry. Still trying to figure out where the bear comes in between Fed and trap.
Yeah.
I guess from my point of view.
Bob, introduce yourself.
Bob Coleman, Idaho Armored Vaults. We run a vaulting service down in Nampa, Idaho, one of the largest private depositories out there, 500 million in assets, so forth. Also investment advisor. I run a hedge fund for physical metals as well. So kind of a little bit different takes. I guess with the Fed, the question is, they've created they have a large array of tools that they use, but one of the things that they did back in 2021 was create this reverse repurchase program, and the design to it was to make sure that rates don't go negative, because in the world that we live in today, U.S. Treasuries, a lot of them are used as money or as collateral for financing, and you can't have negative yielding collateral. It would destroy the repo market. So they've created this reverse repurchase program where basically money markets can now loan their money to the Fed overnight, and the Fed pays them an interest rate. And what's happened is a lot of money now is just sitting on the Fed's books in a way, and not getting turned into the not buying securities or U.S. T-bills, whatever it may be, because at the time, the U.S. government was also buying or paying down a lot of their T-bills as well. So a lot of that money had to go somewhere. So the whole design of the reverse repurchase program was to absorb that money and, in a way, try to create a tighter policy, I guess you could say, but also maintain the interest, try to increase interest rates and use that as a tool to try to stem inflation. So they're coming at it they have different types of programs and so forth. But now that they're entering QT with the reducing of the balance sheet, as well as the Fed or U.S. Treasury coming to market with more debt, now the real question is, when does something really break? Because the markets can only absorb so much new debt or new supply without dislocation. The Fed's not buying any more paper; they're net sellers. Banks aren't buying. The central bank, foreign central banks, they aren't buying on net. You see, with the strong dollar, there's a disincentive. It's costing more to get into U.S. T-bills or U.S. Treasuries and then hedge the dollar exposure that they may have with their investment. So when you add those hedges in there, it starts to create a negative yielding rate. I'm sorry if I'm going too long, but basically, I think now that the Fed, with QT and so forth, I think the question really is will something break before they actually get inflation under control? And that's the biggest worry that I see that's not priced in the market, is that some dislocation is going to happen and force them to reverse policy at some point. It may not be right away, but I think that's the big risk. And then that would turn inflation from everyone thinking it's going to be subdued and so forth to being more sticky, I guess, or more stagflationary. Did I say everything?
Yeah.
No, you're fine.
So this is awkward. This topic is not within my expertise.
Introduce yourself.
My name is Mathew Hunter. A number of you have seen me before. My expertise is in trading, but still a long time ago, and in CFTC rules and regulations and market manipulation, not Fed activities and opinions about current levels of inflation and where prices will go. So I don't really have an opinion. I think it wouldn't be right for me to offer it where I have no expertise. But there's a chance, and I think this is what the idea was. There might be something that I do have something to contribute on, but right at the moment on this question, it's not me. I'm not the guy.
Okay, Matthew, you told me, though, that you were trained by Wall Street. Yes. So can I ask you, what does Wall Street think of the situation right now with the Fed? Is the Fed in a bear trap? Well, how does Wall Street view this in your...
Yeah, so I'm trained as a professional trader on Wall Street. I worked literally on Wall Street. First job, 25 Broad Street, right across from the stock exchange, down from the Fed. But my experience in trading precious metals ended in 1996. I traded electricity, which is the hardest commodity to trade thereafter, and then I went to government. I spent nearly 20 years in government. I don't know what the Wall Street boys are thinking about right now at all, right? Because I'm out of touch. If you want to talk about how a derivative structure works, I might be able to help. But having an opinion about the price of precious metals and if you say classically, how do interest rates affect the price of precious metals? We can talk about that. But I don't think that I bring any particular expertise. That's just classically, this is if interest rates rise, precious metals are soft or stable, which is not a helpful insight.
Okay, fair enough. Okay, our first one we'll give away here, a 5-gram silver stamp. So it's Oh, I'll get them next time. 345-2518. Anybody got that one? So it's 2518. All right, there you go. Okay.
Trust but verify?
Yeah, trust or verify, there you go, right.
Come up with a topic.
So for me, I think the simple answer for myself is looking at all this, it all boils down to one thing, and I think that based on what Jerome Powell said on, what was it, last Friday, Americans are going to have to endure some pain, isn't that the words he used? I think to the surprise of perhaps many people, many investors, they're going to go and they're going to keep raising rates until something breaks. And when something breaks, whatever that may be, I think that's when they're going to have to reverse. I think that's when gold and silver perhaps begin their next uptrend, whether that's a recession. The most common or most reliable indicator of recession is the yield curve, and that most common is the 10-year minus the 2-year. If you look at that, when it goes negative, it's predicted the last 8 recessions every single time. It doesn't mean they're imminent. Sometimes they're within months. Sometimes they've been as long as 2 years before the recession occurred after the yield curve goes negative. So, and it's gone negative. It went negative last month. So there's probably a recession on the way, but it doesn't mean it's necessarily imminent. Do they cause a stock market crash? Is there a problem in the credit market? There's any number of ways this could play out, but until something breaks, perhaps they do continue to raise rates. But that's not going to be that's not a permanent solution, obviously. So, okay, so Mark, how is this going to affect precious metals?
Well, I was just going to say, first of all, Jeff, I agree. I think the driving, for me as an observer of all this, there's a huge amount of political pressure on the Fed to carry through with their comments. I know there's been some debate earlier in this whole cycle that, is it just talk? Are they really going to go through with this? But it seems, based on the minutes from Jackson Hole, I read the speech, Powell seems like a pretty determined, proud individual as well. And it seems like he's going to go through with what they've said. And what they're hinting at is basically that they're going to raise interest rates probably, now it's like most likely to 4%. They're going to carry that through 2023. So in my mind, it's higher than 4%. It might be longer than 2023 because they always make it sound like it's not going to be that bad. This is how they sold us the whole thing 6 to 12 months ago. They said, it's transitional. It's okay. It's slightly above target. It turns out it's out of control. They've lost control. Now they need to swing the pendulum the other way. So I expect them to carry through. I think it is going to trigger a recession, which in my opinion, we've already entered. The definition, the goalposts keep changing. They keep moving. It's confusing as an investor. But I think that it is going to trigger a recession. The good news is, this is what I was getting at, precious metals. I look back and said, well, what happens when recessions come around? What happens to gold and silver? Because really that's what my clients are interested in, and that's the question. The good news is, when most recessions take place, precious metals does well. In 2007 through 11, gold more than doubled. Silver went up 400%. So that's the most recent example that we have to base ourselves off. There was a very short recessionary period at the beginning of COVID. Gold also did well during that period. Silver also had a strong rally during that period. So that's some encouraging news. And also historically, when you have interest rate hikes, gold tends to react well to interest rate hikes, not immediately. It's not a lock and step reaction. It's usually 6 to 12 months after interest rate hikes take place. Gold tends to outperform equities, which it already is. Gold's down 4.5% this year. NASDAQ's down 27%, S&P 13, I think. The Dow 13 or 15, Bitcoin's getting crushed. So we're already seeing that. The only thing that gold is not performing well really against right now is the US dollar. And we'll come back to that in a bit.
Oh, sorry.
I guess if maybe to get a little bit into the weeds with the Fed, how their policies are affecting us. and how I think this recession starts to play out is this quantitative easing or quantitative tightening that they're doing. Now that they're starting to sell 35 billion of mortgage-backed securities or roll it off their balance sheet, those mortgage-backed securities, that program was really helping the real estate market sort of prosper. The mortgage-backed the lenders creating those securities, they had basically someone that they could sell it to. And now that has been kind of stifled, that's another portion of the economy that should start to see some pressure. And so what the Fed's really doing is they're creating almost a closing of walls in multiple different walls are closing in at different locations, so it's hitting multiple parts of the economy all at the same time. So I think the move can, and then you load on there the leverage that's in play, and this stuff, that's why the markets can move very quickly. And the real question is, you can get into this idea with the Fed and the plunge protection team. The people talk about. Maybe Mathew can talk about that. I don't know, or it's something you can't talk about. But the question is, can they walk the market down? Depending on how far they want this thing to go, where they may see demand destruction come in, that gives them enough confidence that inflation's under rein. The problem though is the Fed. They are the market, and they create the money that created the V bottom in 2020, and then it just zoomed. And if they cut the liquidity, the market can always go a lot further down than what you think. And that's the problem. It's like the old adage: the market can become more irrational or longer than you can become solvent, I guess. And that's the worry, I think, that maybe Wall Street, the last 10 years of quantitative easing, has built into this mindset that the Fed will always be there and always come to their help when the markets get really soft. But if their really intent is to actually tighten, and the markets right now are saying, listen, we don't believe you. We think you're going to turn on a dime like you've done in 2018 and so forth. And we could be in for a pretty sharp decline, which could send the dollar higher because you may have liquidity constraints and so forth. But with gold and silver, the real question is confidence. I think that's where the metals start to find some kind of base, is when no one knows where to run or where to hide, and all it takes is for the metals to stop going down to start getting maybe more interest into it. And that's at least my take.
Okay, so next one. Let's go one more here. Who do we got? And it's 345-2513. 2513. Who's got it? Is that you? All right. Very good. Thank you. Okay, let's keep going. How this all affects gold and silver. Mark, you got lots of notes there. Why don't you share with us? Share with us what's going on here. What else do you want to think? Then we'll open up to Q&A, give away some more. Jeff Christian's here. I'm going to make him weigh in on this topic too. Yeah, so we'll get a mic over to Jeff here. Okay, go ahead.
Well, I was just going to, inflation is one thing, and obviously that's been a huge topic. And Jeff pointed out, I listened to your presentation you did on your YouTube, the correlation between gold and inflation, or gold as a hedge against inflation. It's not nearly what people believe it to be, especially right now. It's not as strong as we might be led to believe. That's a really good podcast. If you want to learn more about the relationship between inflation and gold, I recommend you listen to Jeff's YouTube commentary on that. That was very good. But I just want to talk about the US dollar. So moving away, but it's all part of the same conversation. In my opinion, or my humble opinion, I think the number one factor really right now that we're watching for gold is the strength of the US dollar. It has a direct correlation. We've got a US dollar that's at a 20-year high. And I know people throw around things like highs all the time. He's 10-year high, 5-year. 20 years is a really long period of time. Like a lot happens in 20 years. Like Jeff and I had all of our hair 20 years ago. We were rocking, but But my point is, you can't take that lightly. When you hear 20-year high, you have to understand how meaningful and impactful that is. And it's not, there's a lot of things going on. When you look at the US dollar index, obviously the euro is really in the toilet. Europeans even are, my wife is German. She pointed out she doesn't follow the economy that closely. She said, I can't believe the euro's at par with the US dollar. Like, this has never happened before. It's a big deal. The pound is the UK is kind of hemorrhaging right now. They've kind of lost their way. A lot of things going on in Europe. So the US dollar, ultra strong, flight to safety, all of that. But that's putting direct pressure on gold and silver. And I mentioned this in my presentation. Q1, US dollar was up 5.5%. Q1 gold was down 5.4%. 1-to-1 correlation, super, super important. But the point I'm trying to make is there's kind of three scenarios. The US dollar continues to strengthen. Maybe we get to 120 on the USD index. Maybe it starts to kind of go sideways at 109, 110, or maybe, and likely what will happen over time is it comes back to its median. That's what happens with currencies. They tend to come back to their median over time. And what that means for gold or silver is that we should see an increase in price. As the dollar comes down, we will see gold and silver increase in price by about 10 or 15%. That's how far the USD is from its 20-year median, in that range. I'm kind of using high-level numbers. So that puts gold right back at $1,900, $2,000. That puts silver back at $20, $21 an ounce. Just based on the strength of the USD, not factoring in the other things that we're talking about. So there is hope out there. So let's keep an eye on the US dollar. That's the point I wanted to make.
Do you have about 10 more minutes to? It's interesting because the Fed, we're sitting at 40-year highs on inflation, 50-year lows on the unemployment numbers. And I think, and you have the Fed, which is, a lot of academics, that are sort of embedded in their culture. From their standpoint, they probably think they can tighten a lot more than what we can actually, maybe the markets can actually endure. And the economy, the way I look at it is, if the market really starts to slip, and they think they can just pull back on the reins, the problem is the public, after seeing, I think when Powell and Biden had that meeting in June, I think that was a seminal moment. That's basically the public's outrage of inflation got to a boiling point, especially in front of the election, that they had to do something. And so they may try to rein in or pull back even more. And when he talks about the pain thing, at his speech, I think they're underestimating how much the public's going to get pissed if they realize, now this time next year, the unemployment rate starts to go up and they start losing their jobs. It's the old adage, you're in a recession when your neighbor loses a job, but you're in a depression when you lose your job. And that's the scary part that's not priced into the gold and silver market right now, is the political risk. And I think that's what will turn ultimately, I think, maybe not the inflation hedge scenario, but I think it's the political uncertainty scenario, because we certainly see it in Europe right now. It doesn't take a lot. It's like almost like the gasoline is poured onto the wood. You just need the match. And it's not necessarily inflation, because governments can manipulate numbers and they can massage them. They can use hedonic measurements and all these kind of good things. But when it starts hitting people's pocketbooks, I think that's when you start to see the tide turn. And that's something that isn't priced in. So.
I have no opinion.
Mathew, how does somebody make money? Well, you got to weigh in here a little bit more. How does somebody make money in this environment, regardless of what the Fed is doing? Give us your input on how to.
I think.
Use the.
Oh yes. If you're going to force me to speak, this conference has opened my eyes a bit about a number of topics. But one of them, if you think from a trade, we talked about this earlier, and thinking from a trading perspective, individuals, when they decide to do something, should know exactly what the reason for entering a trade is and what the exit strategy is. I think that most people make a mistake when they think about everything is just about making money. I want to make money. So, well, if that's the purpose of the trade, why are you in a physical instrument? All right, if the purpose of the trade is to make money, then the physical is probably not the ideal instrument. There are a lot of other derivatives that are far more liquid and give you the price exposure. When you say, well, my purpose in physical is not because necessarily that I want to make money, I want to protect asset, and it raises a significant number of other issues. And one of those is the belief that it is not just a mild uncertainty ahead, which I would say a recession is, but a lawless uncertainty ahead, all right, which says that value has to be portable and has to be real. Electricity becomes unreliable if you have a lawless situation. So saying I have my wealth on a flash drive that's unreachable, not necessarily a good idea. Land becomes much more important. But the exit strategy is not that you want to make money, it's that you want to be able to use the physical asset for the acquisition of things that keep you alive. So if the view is that in the worst situation, you need to have something hard, then the discussions about the relative value are irrelevant because your exit strategy is never to sell. The exit strategy is to use when there is an extreme situation or to leave to family further down the road if there is an extreme situation. So making money, I think, is the wrong view, right? In my mind, when we're talking about physical hard asset. You have physical hard asset because you really want to protect something else. And we've been talking about this. The price is irrelevant other than you want to buy whatever that you're interested in at its best value, but you're not looking to sell it. All right, you are looking to capitalize on it in an extreme situation. And that is much more important to realize than to say, what do you think the price is going to be this week or next week, right? Or next year. You said, you're not buying it for those reasons. So that's my opinion.
Very good. I like it. Very good. All right. Next up is, so it's 345-2531. 253. All right, there we go. And let's do another one real quick. There you go. Thank you, sir. We'll do one more real quick. Okay. Yep. Next one is 345-2519. 2519. Anybody got that? No? Yeah, I'll keep it. Okay, so let's open it up. We have a little more time left. I think we're allowed to even go over a little bit before the next group is in here. So we'll open it up to Q&A. Jeff, not putting you on the spot, but would you like to weigh in on this, the Fed bear trap? Do you have anything to contribute to it? So anybody that wants to ask a question or a comment, please use the mic. They want us to use the mic for that. So
let me ask the panel a question. You talk about this breaks, that breaks, inflation. Why don't you guys address a third scenario? Interest rates have now risen sharply. They are higher than they're as high as they were 3 years ago. They are a fraction of what they were at any point in history prior to 5 years ago. There's a big capacity for interest rates to rise before they get high, right? Inflation is rising. Actually, the last 3 months we've seen signs of declining inflation rates, and there are signs that it could quell. Maybe not go back to 2%. You know, if you go back to 2019, which was 3 years ago, the Fed was very frustrated because inflation rates had been below 2%. They were down around 1.4% for many years, and they were saying, we think we need 2% to have a healthy economy. I might not agree with that theory, but that's the case. They started rising in early 2021. They peaked, it looks like, about 3 or 4 months ago, and they may be coming down, maybe as low as 4 or 5% by the end of the year, and somewhat lower next year, probably not back to 2% for a while. What happens in this third scenario? The Fed raises interest rates, quells inflation. The world, I happen to say, yes, it looks like we probably have been in a very shallow recession in the first half of this year. We won't know until we see the final second quarter GDP figures. There are often big fluctuations between that first flash estimate, which is what we had, of negative 0.9, and then the second, which comes out soon, and then the third estimate, our final figure for GDP. And we do think that there is a recession coming. What happens if the Fed is able to raise interest rates somewhat? We've seen about $1 trillion come off from fiscal stimuli. And everybody focuses on monetary policy. They don't look at the enormous fiscal stimulus that was behind the inflationary pressures of 2021. But those fiscal stimuli are still there, although they have come off, like I said, I think more than $1 trillion. Actually, I think it's more like $1.7 trillion from last year to this year. What happens if nothing breaks?
Okay, so nothing's going to break.
We have inflation. We've had an
No
inflationary
recession,
bout.
no stock
The
market
inflation
weakness,
comes
nothing
off.
in the credit market. I'm not disagreeing with you, but I'm challenging that.
I'm challenging you to say, what happens if the world doesn't break? Because you
Well,
guys
that's
are
a
saying,
what if.
oh, the Fed's going to raise interest rates and throw us into a recession or a depression, or the Fed can't raise interest rates and inflation is going to go really sky high for a long period of time. What happens if those bad things don't happen? What happens if we muddle through, which happens to be the most common way forward economically?
Yeah. I mean, that could happen. The Fed bear trap is a real thing, in my opinion. So I think it is more likely they continue to raise rates until something does break. And that means that may be something that is not imminent. But I don't think they can do this forever. They can't continue to raise rates until inflation's 2%. I just don't accept that the inflation's going to go back down to 2% anytime remotely soon. And something else is more likely to happen in the meantime. But that's just my opinion. So, Bob, you guys want to weigh in on that? It's a good question.
No. Now give your comment.
Yeah.
So let's talk about uncertainty, because I can buy the premise that muddling through is more likely to happen than not happen. But in that, you'll have some higher rates, you'll have some inflation, there'll be, but the types of where there is risk and uncertainty, that's imminent. So I am personally concerned about what are natural gas prices going to do in the United States through this winter. Because natural gas prices, if they scream enough, will cause significant amount of inflation through electricity prices. That the current high rates of power prices stemming from $9 natural gas, which is roughly 3 times more or less, 2.5 times where it was last year, all right, is coupled to extremely high transportation costs to the major metropolitan systems that hasn't realized yet because winter hasn't arrived. The internationalization of natural gas has impacts for us as we support European demand for gas. They are right in the Ukraine trouble and the Russian war. All of that can get worse. More food pressures can come. And so we can be muddling through and yet still have inflationary pressures that come from our energy sector. What does that mean for precious metals, all right? Frankly, I don't know, but I know that it means uncertainty. And uncertainty may be good for precious metals. If we muddle through, then the question is what happens to the dollar? Because does the pressure on the dollar end? If the pressure on the dollar end, the scenario is more likely that it'll fall towards, move back towards the mean, which means other prices will revert as well, right? That's what it seems to indicate. So from, and I'm going to say an outsider's perspective who's just thinking about the problem, I think if we muddle through, you're going to still get some pressures coming from the international sector, and we're going to get some relief perhaps through changes in the dollar. But you're going to see some higher rates because they promised them to us.
Very good. Okay, next one. 345 2526. 2526. Who's got that? All right. And since our time's almost up, we'll go to the next one. Yeah, thank you. 345 2530. 2530. Anybody want that one? Oh, all right. How many of you won today? I don't know about this guy. There you go. All right. Okay, next question. Any other questions?
There's a manipulation here.
Yeah, right. Our panel's technically over, but we'll just keep going if people have other questions. They don't need the room till 4 o'clock. So, anybody else? We'll just open up to anything. Oh, okay. We got a mic going over there. There you go.
Yeah, I think the only time the Fed has successfully muddled through something was when Paul Volcker was in charge, and he had the character, the gravitas, to keep raising rates, and it actually solved the problem. I think I guess, Jeff, this is more a counter-argument, is that the people there today, is my hunch, are not that competent, don't have that gravitas. And so I think what happens, what will happen, or what I'm predicting, is they'll raise it 100 or 200 basis points, something will break, like it did a bunch of times, sort of around 80, and they'll panic and then come back down, and the hyperinflation will start once again. That's my prediction. So we're not in the era of Volcker.
Your turn. Okay, so it's more of a comment.
Yeah, it's more of a comment.
And somebody else raised their hand, unless you want to say something. Okay, there we go. Oh, right there. He was first, I think, yeah.
Yeah, I was kind of asking a question about that as well, like what duration are we talking about? Like, because there's going to be a crash at some point. There's going to be something will break eventually, right? So, like, I guess what time frame, going back to what you're saying, are you talking in the next calendar year, next, 5 years, presidential cycles? Like, what was the framework? I'd be curious to kind of like see where you guys are at, because I mean, that's almost like a Yellen type comment where we'll never have another recession again, and clearly that didn't play out. So,
Well, I think what Jeff's saying is one option is, his third option is we could muddle through. That is an option. That is a possibility. I just think eventually, and again, my opinion, I'm not an economist, but I think eventually that aggressive nature from the Fed does cause something to give, something to happen, break, if you will. So, and I think that could be the potential catalyst for when gold and silver take off again. So,
I just want your comments or opinions from any of you folks. They keep printing money, and the national debt is ridiculous, and I want to hear your comments and opinions on that.
Yeah, it's irresponsible. It's not only here in the United States, it's also in Canada, it's in the Eurozone, it's everywhere. It's very irresponsible in my opinion. I know that we have a candidate running in Canada now that promises he's going to stop that behavior. He's going to fire the top man at the central bank in Canada. If it continues, hopefully he does. Hopefully he carries through with that promise. Money supply has grown like 40% in the last 2 years alone in the United States. I believe it. If that's accurate, it's completely ridiculous. And so I think that might be the trigger. You cut off that money supply, and I think that could be the trigger for much worse things. And my final comment, and Jeff just touched on it, as a gold investor or a silver investor, I don't know when it'll happen. I don't know what it will be. That's the hardest part. The when is always the hardest part, actually, is the timing of anything. But I'm loving silver at 18 bucks an ounce, and I'm liking gold, at the low 1700s. If your time frame for that exit strategy that we talked about is rather large, then you don't really have to worry about the price right now. And for me, that's my closing thought, is it's a pretty nice time to be adding ounces to the stack, because under any scenario, whether it breaks now or we muddle along and it breaks in 2 years, as Jeff said, either way, the price points right now are pretty attractive. That's my closing thought.
You guys want to weigh in, answer his question?
What I would basically say is the economy could muddle through. The problem is the financial markets, because they're a different world, a different animal. So that, we could have pain on Wall Street, so to speak, but because we have one of the largest or widest income inequalities in the history of mankind right now, and so forth. And so, and obviously, the Fed sees the political pressure that could build. If inflation continues on and people are having a tough time to make ends meet, yet you have the rich getting richer, that type of thing, and that's been a big problem. But the issue is, Main Street will survive, but the financial pressures and the leverage and so forth create dislocations that will hurt the wealth effect. And the wealth effect is what sort of drives our economy. And that's the part that will then affect tax revenues. It's almost like a domino effect. And so my concern would be, the muddling through is just trying to sustain the economy, but the structure behind the economy or the foundation is still crumbling underneath. And it makes a lot of sense what Jeff's talking about. I think 2024, everything's going to hit the fan, especially with the presidential election. The country's getting more polarized. You throw a recession into the mix and adds pressure into people's pocketbooks. People are going to get mad, and that's something that, again, hasn't been discounted in yet. So,
very good. Mathew? No? Okay. All right. Next one is 345-2525. 2525. Who's got that one? All right. Good. Hey, I think you're related to one of these guys up here. So I don't know if this is an inside job or what here. So get you. Okay, one more real quick. 345-2527. 2527. All right. These are neat little things. I like these. Okay, any other questions? All right, if you drop it, you have to give it back. Okay. Yes, sir.
Many people in our country live paycheck to paycheck. And with gas prices where they are and food prices where they are, many people are buying that stuff on credit and, writing themselves loans with credit cards at high interest rates. And I think that's the situation is worse than a lot of us think. I think there's going to be a huge temptation for political unrest. I don't know what it is. Seems like every week in the news there's some food processing plant catching on fire. I don't see that being addressed. I don't see people being arrested and charged with crimes for that. And I just see lots of stuff trending toward crisis situations. And I don't know if anybody else sees that, or if I'm crazy, or what the deal is.
You're crazy. No, it's pretty obvious. The system, the risks are increasing. The vulnerabilities in the system are increasing, whether it's monetary, financial, market. I mean, they're all increasing. And that makes us increasingly more vulnerable to some type of event no matter what it is. So I see what you're saying. I agree, and I'm just glad I'm a gold and silver owner for that. So anybody else want to weigh in on that comment?
I see it too. It's happening in Canada as well. We're a very polarized country right now. I see it here in the United States when I visit. It doesn't take very long to, here in Spokane, there's a lot of homeless folks. You notice that right away. So we talked a lot about economics and money, but the social aspects of what's happening right now is super concerning, actually. As a human being, it's very concerning to witness. So you're not the only one. That's something we talk about at home as well. I can tell you that for sure.
One of the reasons why I developed my own depository back in 2006 was one of the risks I looked at was political, and the idea of socialism and fascism getting polarized. Where do you go when you get into a more, I don't say fascist state, but more Big Brother kind of says, listen, we'll protect you, but it's going to cost you this. And the problem I see is being on the East Coast, where traditionally where a lot of depositories are, how fast can you get your metal across the Hudson River if everything really hits the fan? And the idea is, you're going to have problems just getting across, into the river or into the city to get your metals, or over to the East Coast into Delaware, because those are high population areas. Because I've talked to, when I started developing my thing, I talked to people over in Thailand, in Bangkok, where you had a lot of political coup and a lot of turnover there, and try to get an understanding of what a country looks like when you get into these political situations or crises. It's not pretty. Gold and silver to me are basically a bridge between point A and point B. I don't know what that point B is going to look like, and I don't know what the chaos between point A and point B is going to be like. But to me, I just want an asset that doesn't have any counterparty risk to it. Like I always say, it's a return of capital, not a return on capital, is why I own it. But it is a huge concern. We're looking at extremes. You're looking at a market now that's extremely financialized, extremely collateralized. We're trading, treasuries amongst, financial institutions, rehypothecating the same exact treasury. A hedge fund wants to borrow money. They give the treasury to a dealer for cash. That dealer then gives it to an insurance company. It's the same treasury going from hand to hand to hand. It doesn't take a lot to break this stuff. And then you look at the structure of, and I get the cryptocurrency thing. It's a novel idea to try and have assets outside the system, but even that's dependent. And then that's under, you have regulation that could come in and stifle the movement of money or the movement of assets, on and off the exchange into, the financial markets. So you have the idea of potential capital controls and monetary controls. So those are things that at least with the physical metal, it gives you some flexibility. That's all I guess you could say. And we have no control. If everything does hit the fan, there's nothing I can do about it. All you can do is kind of sit in the corner and with a bag of popcorn and just watch it in front of you and try to protect yourself, I guess is all you can do. Plus you have a lot of weapons and bullets, but that's another story.
Mathew, no final comments? Okay, last one. 345 2521. Yeah. Darn it, I didn't end up with one. There you go. Okay, we got time for one more question. Anybody else want to weigh in? Open forum, any question at all?
So, CBDC, and you mentioned food supply. We're watching that go down. There's a lot of crazy things going on that seem to be converging probably sometime this fall. We're going to see the crop outputs that I think are going to be really in poor shape this year, leading to a food shortage at a minimum. Could be far worse. We're seeing energy crunch coming in. We're seeing the dollar start to fall. And it just seems like we're getting pushed into this big thing that's going to hit all of a sudden. And I don't know if you talked too much on CBDC, And maybe that's where we're going with this and how gold and silver would work in the aftermath of a CBDC when everybody is forced over to a new currency system. And my other comment is, as we look out and try to muddle through what we can foresee in the future, I didn't hear any discussion of black swan events. COVID came out of nowhere. And look what happened there, and look what's happening with the droughts this year and the crops, and as we see all this stuff. And I think you have to, we don't know what it's going to be, but we have to factor in some type of black swan event or events. We didn't see Russia invading Ukraine. Is that going to bring us into a war? Are we going to be involved with this thing in January? And that's going to be all of it's going to be a big deal. So I guess my question, getting back to that, is my comment for everybody when they think about what's happening in the future. But if you didn't touch on CBDC, what's the aftermath for the people holding precious metals?
So I went back and looked at least 20 years, and I looked at all the crises that we had, whether they were monetary, financial, market, whatever. And roughly speaking, 50% were black swans. I looked to see, okay, did someone predict this? Was someone expecting this? Was the mainstream expecting this? And they were not about half the time. So, that's a great observation on your part. I think we do need to be prepared for black swans. And circling back to the whole theme of this panel is that the Fed does have a trap that they're setting for themselves. And Jeff could be right, but the vulnerabilities, the risks, the uncertainties are growing as we go through this thing. And that's why I think, I personally am glad I own gold and silver. So CBDCs, real quick. Comment.
Sorry, I don't have a comment there, but I did want to say, you just made me think of something, Jeff. My mentor often positioned gold and silver as wealth insurance. That was the best way that he could, after all throughout his career, why would you own it? And this goes back to what you were saying earlier, is you don't buy gold and silver to make money, you buy gold and silver to protect your wealth and to protect your family at the end of the day. And I think that ties into the uncertainty, the black swan events, all the things that could be coming. It could be a number of things, and the timeline is not always clear. But if you have that wealth insurance in place, you're in a better position than if you don't. And unfortunately, 97% of the population doesn't have it. So we're amongst the few and lucky ones.
Lock the doors. They're coming. I think the CBDC, I think the real issue is going to be control of transactions, kind of like what happened in Canada. Shutting down your bank account. The worry that I think we see with CBDCs is just the reach of tax revenue, the reach of, hey, listen, we can, it's maybe a way to create monetary policy that's more designed to be specific to certain groups of people or whatever it may be. But I think it's the bigger concern is the reach of government into our lives, I guess. It's funny because Cash Carey, the Minnesota Fed governor, came out and was making a comment. He said, what really is the use case for CBDCs? I mean, you have Venmo, you have PayPal, and all these types of transaction services that work just fine. It's just maybe another. It may not make any sense from a political standpoint, but from a transactional and economic standpoint, it may create more strife. It certainly, I would imagine, it may be very easy to do transactions and settlements, especially cross-border, but from a confidence standpoint, it may actually create a feeling of fight or flight in terms of I want to keep my assets more private. And that's why I keep backing into this picture that the industry has to tell people that gold and silver are private property. It's one of the few things that that you don't have to register every single year or get a license for. I mean, so it can be bartered with the guy next door to mow your lawn, and you don't have to run it through 15 million nodes or whatever to get payment confirmation. But I think that that would be the only reason they would do it, is really more for control. That's the only thing that makes sense to me.
Bob, I'll mow your lawn for an ounce of gold. Okay, all right. Okay, thanks everyone. Hope this was useful. Here.